presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak YouTube update for April the 23rd, 2024. I'm Mo Ansari, President of Compak Asset Management. Thank you for joining me today. Let's start first of all, compak.com/media. You can get all of these updates absolutely free simply by going to compak.com/media. Just sign up, you'll get the YouTube update, you'll get the podcast, you'll get the weekly newsletter, you'll get notifications whenever I post a new update. So make sure you sign up, and you can also get all of the newsletters simply by going there, and they're all free. Looking at the markets, down 3% last week. Big down week for the markets, but I think last week was the bottom, at least temporarily. And I'll tell you why and tell you where we go next from here. But that's what it was. We're down about 5% from the top. That's a normal pullback. It's not even a correction. Pullback 5% to 10%. 10% is a correction, and anything more than that, then we get into a different territory. Dow Jones was just about flat. NASDAQ was down 5.5%. So that is where we're seeing some selling. I think unwinding some of the overbought situation that we had in the AI stocks and all of that, especially the Max 7 as they were called, and now some of them are dropping out of the Max 7 and so on. But I was talking about this in March, February and March. I was expecting a pullback. Market continued to go up, made the high at the end of March. Markets have a tendency of going much farther on the upside and the downside than what is reasonable, and that's what we saw on the upside. I think the market got ahead of itself. Interest rate cuts, 7 interest rate cuts. Everybody was talking about 2024. Now, about a week ago, everybody's saying, well, the Fed is going to raise interest rates. That's the other extreme. I don't think that's happening. Also, we need to see some slowdown in inflation. We need to see some slowdown in the economy for Fed to justify cutting interest rates. I still think we get 2 or 3 interest rate cuts between now and the end of the year. The timing is something that is still questionable. When does that happen? But that all depends on how inflation goes. The big components of inflation, I've talked about that. Last week, utilities was the best sector. Technology was the worst sector. So we're seeing this turnaround from one extreme to the other. Interest rates backed off a little bit. Oil also backed off. We're still about $10 higher than where we were at the beginning of the year. Looking at the 10-year yield, it's still at 4.62. At the end of last month, we got to that resistance area that I talked about on my charts last week, touched it, backed off from there. As long as we stay below that resistance area on the 10-year, we're okay. If we break out above it, then we could get another pullback in the market. And I'll show you that chart a little bit later on when I take a look at the technical. Same thing with the S&P. I talked about that between 5,000 and 4,900, somewhere in that vicinity. I thought we should make a bottom. Well, last week the low was 4,953, and we bounced up dramatically from there. But was that the bottom? We'll talk about that in a second. Most of the U.S. companies, 87% of the companies that have a revenue of 100 million or more are owned privately. So there's not a lot of stock out there that you can buy. Looking at the data, new home sales, consensus is 6.7 million. Previous was 6.62. So a little bit better in new home sales. Durable goods expected to be up about 2.5%. We are up. Previous was 1.3%. Then we get initial claims for unemployment. First quarter GDP, that's going to be critical. 2.5% is the expectation that the first quarter grew, and that's a pretty good rate of growth. Previous was 3.4. That's what we saw previously in the previous quarter. Then we get personal income. So not a lot of data, but that GDP number is going to be something to watch very carefully that we get on Thursday. Looking at the technicals, market made that third wave. This now is turning into a third wave, as I said. This is the fourth wave pullback that we're getting. Looks like fourth wave. I said between somewhere around 5,000 to 4,900 is what I was looking for. We got here on Thursday, bounced up on Friday, and then we bounced up yesterday and today. Resistance is going to be 5103. That's the 20-day moving average, and 5120. If we get above 5120, then we're headed higher. But fourth waves are choppy. They bounce around, they go down, they go up, they go down, and it's a process. So I think we stay here between about 5100 and 4950 when we confirm as we make this bottom. If we get above 5120, then we're headed for the fifth wave high, which from there I'll give you a projection next week where we should be going. Around 53.5 to 5400 is the first target. Same thing with the weeklies. We hit the high, third wave high, came exactly to the 20-week moving average. You can see this red line. We came and kissed it, just got below it last week. This week we got right there on Monday morning's open. Then we took off from there. Looks like this is the target right here. But if we get above this is a very minor target of about 53.5. But this is right here, 5,400. Then we're looking at 5,600. So, but again, fourth wave, that's what we're in after. This is where we are. And those are choppy. If we break this 49.50, then things get a little bit complicated. Then we're looking at somewhere around 4,700 or so as the next support area. So this has to hold right here, last week's low. If we break last week's low, then I think we could get a deeper correction. But that'll depend on inflation data. That'll depend on what the Fed says. The Fed says we're not in a hurry to cut rates. Again, they were in a hurry to cut rates last year. So they talk a lot. Market leads the Fed. We will have to wait and see how the data comes out and what the market does. The NASDAQ, on the other hand, wave 1 to the downside, wave 2 to the upside, wave 3 down is what we're in. Looks like this is wave 4. Again, 5,927 is resistance. That's the 20-day moving average. 50-day 16,050. We're at 15,727 this morning. So a little bit of a bounce here, but I'm not quite ready to say. I still think we are going to see this rotation out of the tech and into other stocks. Weeklies, again, we got below the 20-week moving average. We're above it today. But again, if we get an ABC, this is A, we get a B to the upside, that's what we get. Then a C again to the downside. So that's what usually happens as long as we don't start 5 waves to the downside. So ABC is what we're in right now. And I think that's going to be back and forth for a while. Same thing with 10-year note. This is the number that I talked about, 4.7. This was the resistance area. We hit that exactly last week right here, 4.7. And now we backed off from there, which is a good sign. As long as we stay below 4.7 on the 10-year note, we're okay. If we break out above 4.7 and fill this gap right here, this is a huge gap right here. That's where we broke down. This was last November, beginning of November, end of October of last year. That is going to be a resistance. If we get above 4.8, all bets are off. Probably we're going to see a deeper correction, maybe as much as 10% on the S&P. So 4.7 to 4.8 is something to watch on the interest rate on the 10-year. I think that's going to dictate what happens to the stock market next. Crude oil hit a high, backed off after all of the turmoil in the Middle East. We're sitting on the 20-day, 50-day moving average, which is 81.26. Today we're 83.30. Got pretty low this morning. We were around 81 this morning, but then bounced up from there. So we got close to that 81.26 and bounced off of it. Resistance 84.40. Again, fourth wave is what we're in. This was wave 3 high, fourth wave to the downside, but fourth waves are choppy. They go back and forth for a period of time. Small caps hit a high. I was looking at 208 to 210. Support 190. We got very close to that. This is wave 1, 2, 3 to the downside. That's what we're in, wave 3. Wave 4 to the up now. That's what we're in. 202 is the 20-day moving average. And then we get to 190. I think we're up as far as we go, then we come back down. We'll test this low again. That depends if this all becomes an ABC, this whole correction from this to this. We'll have to wait and see. As long as we stay above 190, I'm okay, and I think that is a buying opportunity. But it all depends on interest rates. As interest rates go up, the small caps get hurt the most. So we have to watch the interest rates, 4.7 to 4.8. As long as we don't get above 4.8, I think it's going to be an opportunity. Gold had a big run to the upside, hit this high of about 24.50, backed off from there. We're trading around 23. Yesterday was a big down day, about $70 to the downside. Support 23.29, but again, wave 4 is what we're in right here. Wave 3 high, wave 4 down, but again, we're in wave 4 right now in a lot of these markets, and wave 4 are choppy, sideways affairs. Looks like we made a bottom, bounce off of it, then come back down again. So we'll have to wait and see if these lows hold from last week. If not, we're in for a deeper correction. If we do hold and we get above on the S&P around 5120, then I think we can say, okay, we're on our way back up again. So next couple of months, again, May, June, July, are usually months that we bounce around a little, especially the summer months. Then we've got the election coming up. That should create some uncertainty. But by August, September, we'll have a pretty good idea who's in the lead, who's going to be president. Market figures that out, makes the adjustment, and off we go. So, and by that time, we'll have some more clarity on the economy, on the inflation. So next couple of months, as I mentioned, choppy, sideways, opportunities to prune and plant, trim a little here, plant a little there. Stocks that you don't have, that you want in your portfolios, might be an opportunity to add some of those. Again, don't forget to subscribe. Go to compak.com/media. Go right there, sign up for all of these YouTube, and I'm going to do the podcast with Javed later on today. If you're a subscriber, you automatically get that. It's all free. Plus, you get the weekly market minute, my one pager, what am I thinking, one chart of the week that I'm really concentrating on. Those are my thoughts. Those are my views for April 23rd, 2024. Thank you for joining me today. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.